Hey everybody, welcome to Trading Capital. It is Friday, May 13th, closing the week up, wrapping up the precious metals. We have seen continued selling. Clearly on the gold chart here, you've had 1, 2, 3, 4 weeks of downward pressure, and you can notice we're right into some support. We've been watching this trend line. We've been talking about this trend line for quite some time now, and we have finally been patient enough to see it hit our level. We've been calling for lower gold. Today we opened a position in the GLD, so it's beautiful to see that. Now gold can potentially go a little bit lower, and the crazy thing is to think we loaded up on gold around this level, sold at around the 2060 level, and now it's retraced full move in a couple months, and now we're getting an opportunity to buy this bullish price asset at a hugely discounted rate from where we just sold it. That's the power of swing trading, is that we're not stuck in dead money as a long-term investor. We get in, we get out, we capture the moves, we take our profits, and we look for the next setup and opportunity. And what's crazy is that this is a weekly basis that we're looking at gold, so you have a longer-term view of this bull flag pattern that we're experiencing. Now, a lot of people have been watching this multi-10-year arc formation that gold has been in. And a lot of people have been using it as the major support of this pattern. And you can notice that over time, throughout the history, we've come down, we've hit it, we've bounced, we've hit it, we've bounced. But this arc has kept us in check numerous times where we get close to it and we bounce. It's like it's this imaginary force field keeping the move upwards. And notice here, when we hit the end of the arc here, we hit it once, we hit it twice, we hit it 3 weeks in a row, 4 weeks in a row, 5 weeks in a row, and it was on the 6th week. Then when we hit this support arc, we bounced off and broke out. And obviously this was the war, the fear trade. But nonetheless, this cycle, and we've mentioned this in previous videos, doing a little bit of cycle analysis on how gold moves. And it's really freaky in my opinion, the correlations that we can make to the previous cycle in the early 2000s. I covered this in great detail a few weeks ago, and this is playing out tremendously to a T. It's actually blows my mind, the technical analysis and how the patterns just keep playing out one cycle after another. So we've had 4 weeks of downside into resistance, but the key thing here is that you're having this flush out in gold now in the precious metals because you've broken this key arc formation that's kept you in check for more than 10 years. It's now the sentiment and the in terms of some long-term holders are finally looking to get out of gold because it's broken this key support level. However, if you include some previous cycle analysis, simply breaking this trend, this massive arc formation, yes, it's concerning. But when you realize that this is typically how gold moves and you have a cycle to compare it to that is pretty much near identical to the cycle that has transpired now, it's just incredible to know that gold is going to move much higher in the year. So two things I want to point out. We're going to take you back into the early 2000s to match up this cycle with the previous 2000 cycle. So notice right off the bat, one thing that we have to keep in mind is we have the double top. So we have that top there, and we have this top here, double top. You failed to take out the all-time high, and you've put in this weekly topping tail. So you have the double top with the weekly topping tail, hard 4-week sell-off. You've broken your key 10-year arc formation. Now, if we go all the way back down to the early 2000s, notice here how from 1996 to all the way to basically 2004, mid 2004, you had this massive multi-year arc formation, kind of like what we have here. So very similar, just lower and a lot longer ago in history. And the key thing that I want you to pay attention to is, look what we have. The same double top as we have in the previous cycle, as well as the topping tail. And then look, you broke this multi-support arc that was here for over 10 years. You broke it with 1, 2, 3, 4, 5, 6, 7 weeks of downside selling. And had you, an investor, been spooked out as you broke this arc, you potentially have now you did miss out on one of the best rallies in gold's history. So to think that, yes, gold has broken this multi-decade arc formation, however, this is all in the same pattern that gold has typically done throughout its history of the cycles. So if we look, remember, double top, topping tail, broken the arc formation with multiple weeks of downside selling. And then you had the massive run, bull run. Here, similar thing. You've been kept in check by this arc formation for multiple years. Now you have this double top with a weekly topping tail, multiple weeks of downward pressure, broken this arc. It still favors a move a little bit lower according to the past cycle, but the fact that you have this basically three of the same factors right now that are contributing. You have the double tops, which is the same as the previous cycle. You have the weekly topping tail, which is the same as the previous cycle. And you have multi-weeks of selling, downside pressure, breaking your multi-year arc formation. So you have so many different factors aligning with exactly the previous same cycle in gold. If we flip to the GLD, one of the reasons we bought the GLD, I'll just flip here. You can see we've had massive sell pressure all the way down from 186 on the GLD to a low of 168. There was a key technical gap here that we could not pass up. We played this gap. Yes, we're slightly out of the money. We're flat on the trade. But when you look at what we are into in terms of support, so we have this trend line here, which you can see we pivot high, kissed it right into support. And then you also have this secondary trend line, which you basically gapped over. Whenever you gap over a trend line of support, it stands to suggest you're going to recapture that in the near future. And I certainly do think. And then to add in another trend line, you have these trend lines connecting pivot low, pivot low, pivot low, pivot low, and now your pivot low. So you have massive support. Could gold go lower or the GLD go lower? It absolutely could. You have a little bit of a gap fill here. You do have these major double bottom pivots where I think will be a great area to accumulate more. You do have this gap fill around 160. In the event that you keep going lower, I have no problem accumulating more GLD. You can see we have multiple buy levels on the way down. I doubt it would get down to this 150 level, break this pivot low, but there's always the possibility. I certainly think, though, gold by the year end is going to break out of the all-time highs. So just by us starting to accumulate a position here, I definitely think there's more than 15% upside in gold, and gold is one of the safe assets that's going to reduce the volatility in your portfolio. It's going to protect you from inflation over the long term, and it's just that insurance policy from all the risk assets out there. If we take a look at SLV, we also added more to our silver. Look how beaten down silver is over the last several days. It's completely crazy. It's broken this double bottom. Your next level on silver, where we'll be a big buyer, we did add today at the SLV, but this 1956 mark will be a huge level. If we flip to the SLV, we are out of the money slightly. Our average is sitting at just above $20, and it's trading at around 1950 in the post hours. If we flip to the daily chart, you can see that there's gaps all over the charts. Silver's completely oversold. Silver could come down and fill this gap, which just so happens to coincide with this pivot high and this chop in here. So there's a high probability that silver goes a lot higher. I'm in the camp that silver also takes its all-time highs out, maybe not in 2022, but possibly early 2023 to mid-2023. We could see a massive move in silver. And believe it or not, silver is the only commodity in the world today that has not taken out its previous all-time high that was set back in the year of 2008, or even this high here, sorry. So silver's, yes, one of the very few commodities that has not taken out its all-time highs in 2011. Most of the other commodities have taken out and set new all-time highs. So it stands to suggest as one of the most undervalued assets there is. When we look at the real estate, I want to bring your attention to the real estate sector. The IYR, which tracks the real estate ETF, just hit major support. You have your pre-COVID high, you have your multi-week consolidation before breaking out of this longer term trend that you've been trading in since your 2007 high, and your 2009 housing crisis low, which matches up with your pivot here, your pivot low here, and then anything above this channel was your QE, free money printing craziness. Basically, the mean reversion to the upside there that was stimulated by excess liquidity in the system. So now that you've hit major support on real estates, this has favored a small bounce because interest rates have cooled off slightly. They're looking to consolidate to move higher. As interest rates move higher, I do think you break this major support. Once you break this major support, it's not a lot of support that's left in and around this range here. I think you come right down to this gap fill, which is basically another 19% lower in this real estate ETF, which will put a tremendous amount of pressure on the real estate sector. And it really makes sense as rates rise, as people are spending less on housing, as the economic demand and growth slows down. It certainly favors more downside in real estate, especially if those rates keep rising. And if things get really bad in the real estate sector, you could break this gap fill. And if you break that gap fill, you're most likely heading all the way down to this lower end of this range, which is your longer term trend. I think because you were so out of whack with pricing, it's likely that you have a severe mean reversion if the economic conditions deteriorate. And when I say economic conditions, the economic conditions that I always and only refer to are pretty much the Federal Reserve. The Federal Reserve is the economic condition. Whether they're stimulating or whether they're tightening, that's really the two things that are going to be the driving force and dictate. Let's not overcomplicate it with other ratios and other things. Sure, you can include multiple sector analysis and where money flow is going, but ultimately, if the Fed's printing money, assets are going to go up. If the Fed's reducing the money supply and tightening and selling the balance sheet, assets are going to go down. It's that simple. So if they stick to their economic tightening, real estate is going to be one of the severely effective industries. If we look at another supporting commodity that supports the overall thesis for more downside in the housing market, it is the lumber. Lumber is a huge ratio. It takes around, I believe, 16,000 square feet of lumber per the average home to build. So lumber is kind of the leading indicator. When lumber starts falling, it often means that the demand for lumber in the housing market is slowing. So as lumber falls, use it as a leading indicator to dictate where the housing market's going. I certainly think the housing market's slowing, the overall economic growth is slowing, and as lumber falls and has its mean reversion, just take a look at this, basically this trend here, all the way back to the 73, 72 area. So this was your trend, these two green lines, for over 50 years, that was your trend. And then you hit COVID and the money printing, and you broke out of that 50-year trend, retraced back to your average trend, and then broke out again, retraced back to your pivot high. Such a technical breakout here. And then you broke out again, retraced again to your next high, and then you broke out here and made a crazy run up to the upside on lumber, had a mega crash. Now you've had your technical bounce that retraces most of the move, but you're ultimately going to see more downside pressure. The next level of support is this. I do think you break this trend line very easily as economic conditions deteriorate. Ultimately, I do see a potential to test the COVID lows again down here. If for some reason it gets really bad and we do have a true recession, you're going to probably test the low range of this channel again before you get into some sort of equilibrium bounce. If you take a look at lumber on a monthly basis, it has one of the nastiest topping tails I've seen in a while. To think that in 50 years the price just spiked like that, and that's not because of Russia, Ukraine, that's because of our politicians' reckless monetary policies. And that is an understatement. Reckless is an understatement. They should be disgusted in themselves in terms of the wealth destruction, poverty, economic, frustration, uncertainties, and basically it's theft what they're doing. They're robbing their own people to fuel their own deficits and budgets and golden star pensions and whatever else bullshit that they want to throw in the mix. But needless to say, weakening lumber correlates with a weakening real estate sector. So it does stand to suggest that we'll have to watch those correlations, because when the real estate market comes down, it will put a tremendous amount of pressure on the stock market because stocks are the most liquid. So people will sell their real estate last. It's more difficult to sell. And if they need cash and capital, they'll sell their stocks to support their falling real estate or rising mortgage rate prices in order to potentially hold on to their real estate investments. And generally that's what we see in the crashes or the events leading up to a housing crash or potential market crashes. We see the most liquid stocks and assets go, which is the stock market, and people will try to use whatever profits and hopefully money that they have left over from their stocks to support their bigger real estate investments. And often it's a black hole of money pits where they get spooked out, they sell their stocks, they put it into their real estate keeps going down, rates keep rising, their payments get more higher as their asset devalues, and then they end up selling their real estate, or they try selling their real estate at a loss. So they've lost their stocks, they've lost their real estate, and then the market bounces. Now it's a long process. It doesn't just happen overnight, but long and short of it is it does unfold in a scenario of that nature. I hope all of these videos have helped. We have certainly covered a lot. We have certainly made many trades this week. It's been relentless in terms of the amount of buys that we've been having to do with 6 weeks of downside pressure in the markets. A good 1 to 2 weeks of upside is likely, and we'll just have to monitor it day by day. But fantastic jobs, everybody. Take a break, enjoy your weekend, and take care of yourself. Thank you again for being members.